Welcome to vTalkInsight, Allocator's Lens Daily for April 9th, 2026. A fragile ceasefire in the Middle East has triggered one of the sharpest oil price drops since the pandemic, unleashing a powerful relief rally across global equities and a rethink in bond markets. For allocators, the key question now is whether this risk-on turn can outlast the underlying energy and inflation shock that has not fully worked through the system. Let's start with equities, where the repricing has been most dramatic. In equities, the ceasefire has flipped the narrative from drawdown risk back to chasing upside, at least for now. Global stocks have bounced hard, with the S&P 500 gaining about 2.5% in the latest session and European benchmarks like the DAX jumping more than 5% in a single day. The rebound is broad-based. Small caps, big technology names, and travel and leisure stocks are all participating, and the Nasdaq is now only a few percent away from its highs. That tells you risk appetite has snapped back quickly as headline energy prices dropped. Leadership is coming from familiar places. Mega-cap technology and consumer names tied to artificial intelligence and digital spending are again out in front, with companies such as Nvidia, Amazon, Meta, Alphabet, and Broadcom all seeing strong gains on a mix of earnings momentum and the ongoing AI investment cycle. Asian and European markets are adding to the story. Chinese and Hong Kong equities are rallying on both the Middle East truce and supportive signals from Beijing around e-commerce and domestic consumption. While in Europe, more than 500 names in the Stoxx 600 advanced, on volumes running well above recent averages, suggesting meaningful repositioning. Under the surface, the rotation is stark. Energy producers, which had been the winners during the height of the conflict, are now notable laggards as crude collapses. Major European energy names like Shell and BP have fallen around 7 to 8%, and energy is one of the weakest sectors even as indices surge. By contrast, airlines and travel are enjoying a powerful tailwind. Lower oil and natural gas prices are easing cost fears, and despite a lag before those moves fully filter into jet fuel, carriers in Asia and Europe are already being marked up. U.S. and global travel and leisure stocks are rallying double digits in some cases, helped by resilient premium demand and company results like Delta's, which showed strong earnings even while management trims capacity growth to manage fuel volatility. From a fundamentals lens, the equity story still leans supportive but not uncomplicated. Earnings estimates for the S&P 500 are being revised higher across both large and small caps, and some forecasts now look for more than 11% earnings growth in 2026. Historically, that sort of double-digit growth backdrop has aligned with strong equity performance. However, there are questions about how much good news is already priced in. Some analysts argue that current profit expectations for Europe and the U.S. are too optimistic, with more realistic growth in the mid-single digits for Europe and around 10 to 12% in the U.S. At the same time, institutions remain cautious. Trading volumes in global benchmarks have been below average in recent weeks, and hedging activity across equities, credit, bonds, and oil had reached extremes reminiscent of past wars before this truce. Positioning adds another layer. Hedge funds and trend-following strategies had swung defensively, especially in Europe, with record short positions in some indices. The ceasefire has forced rapid short covering, which is fueling part of this surge. Systematic models could add several $100 billion of incremental buying if key equity levels are breached, which keeps the upside path open in the near term. The risk is that this proves more of a positioning squeeze than a durable re-rating. The ceasefire is explicitly temporary. Over 800 vessels remain stuck around the Strait of Hormuz, and institutions know that the earlier spike in physical energy prices has yet to fully hit Western inflation and growth. Volatility remains elevated, with very heavy turnover in large equity exchange-traded funds. So allocators may be weighing the appeal of strong earnings and AI-driven growth against the possibility that inflation and margins come under renewed pressure later this year. Those trade-offs are most visible when we look at what is happening in rates. In rates, the oil shock reversal has taken some heat out of inflation expectations, and yields have responded. Government bond markets have rallied as crude and natural gas prices collapsed, with euro area curves moving sharply lower and U.S. Treasury yields drifting down across the board. Italian 10-year yields, for example, have fallen by more than 30 basis points as traders quickly price out the prospect of further near-term tightening by the European Central Bank. In the U.S., 2-year and 10-year yields have both edged lower as bets on future Federal Reserve cuts cautiously reemerge. Even so, the policy debate is far from settled. On one side, the recent disinflation in shelter costs and wages, combined with the latest drop in headline energy, supports the view that the inflation shock is modest and fading. Some houses now look for 1 or 2 Fed cuts later this year, and investors are also discussing the possibility of pauses or eventual easing from the ECB and the Bank of England as growth slows. On the other side, several Fed officials remain wary. They see core inflation running above 3%, elevated energy costs feeding into transportation and manufacturing, and a still resilient labor market. That camp argues that policy should stay on hold for an extended period, with a meaningful risk that no cuts are delivered this year if upcoming consumer price and personal consumption expenditures data stay firm. For allocators, this leaves rates in a narrow but important balance. Some see bonds as increasingly attractive if growth downgrades gather pace, pointing to tight credit spreads alongside higher real yields as a sign that inflation fears are being overpriced relative to growth risks. Others are more cautious on duration, preferring shorter maturities because persistent energy uncertainty and fiscal pressures could keep yields higher for longer. Upcoming data on income, spending, jobs, and euro area producer prices will be critical for either confirming the recent rally in bonds or forcing another round of repricing. Whatever the outcome, shifts in the rate path are already shaping the behavior of credit markets. Credit markets have been surprisingly calm through this latest geopolitical swing. Public investment grade and high-yield spreads remain contained, and in some cases have tightened alongside the equity rally and the drop in headline energy prices. Emerging market credit is also benefiting from a weaker dollar and improved risk tone, especially in Asia. That resilience suggests that, for now, credit investors are more focused on the growth backdrop and strong corporate balance sheets than on shorter-term volatility in oil and rates. The picture looks more fragile in private credit. One of the flagship income funds in the space has seen redemption requests around 22% of shares in the first quarter, far above industry norms, with actual payouts capped near 5%. Rating agencies have moved their outlook on that vehicle and the broader sector to negative, underscoring mounting concerns about liquidity and the ability of some funds to honor exit demands in a stressed environment. There is also growing unease about how exposed traditional banks are to non-bank lenders, including through complex collateral arrangements that could amplify any problems. Views diverge on whether this could escalate into a systemic issue. Some analysts highlight that overall system leverage is lower than prior cycles and that bank capital buffers are stronger, which would limit contagion, even if individual funds experience pain. Others warn that the combination of higher rates, slowing growth, and redemption pressure could still produce meaningful spread widening and idiosyncratic defaults. What is clear is that liquidity is being repriced. Electronic platforms are reporting record trading in government bonds and mortgages, while activity in credit has been more cautious. For multi-asset portfolios, that split argues for close monitoring of private vehicles, bank exposures, and the behavior of credit spreads relative to equities as the ceasefire story evolves. FX markets are offering another window into how risk is being reallocated. Foreign exchange markets are echoing the risk-on tone. The dollar has slipped from its recent haven highs as the ceasefire and the drop in energy prices reduce immediate tail risks. Emerging market currencies, in particular, are recovering, helped by the combination of easier global financial conditions and optimism that shipping disruptions will gradually ease. Asian assets stand out. The Chinese renminbi has strengthened to its firmest levels in over a year, and regional equity markets are rallying on both the truce and signs of domestic policy support in China. That mix is encouraging carry and local currency exposure back into investor conversations. However, the FX story is as conditional as the truce itself. Analysts stress that the ceasefire is short and fragile, with unresolved issues around the Strait of Hormuz and regional proxies. If tensions flare again, safe haven demand for the dollar could return quickly, reversing some of the recent gains in emerging market currencies. Longer term, there is interest in diversifying reserve assets, with countries like China, India, and Turkey adding to gold holdings, but structural barriers still limit the renminbi's global role. For allocators, that means FX is both a source of opportunity in this relief phase and a channel through which any renewed energy or policy shock would likely be transmitted. Those same forces are most visible in commodities. Commodities remain at the core of today's cross-asset story. Crude oil has just experienced one of its sharpest single-day declines since the COVID era, with major benchmarks dropping well over 10% after the ceasefire and natural gas prices in Europe falling almost 20%. This sudden collapse in front-end prices has slashed the visible geopolitical risk premium, eased near-term inflation fears, and turbocharged the rally in energy-sensitive equities, from airlines and logistics to European industrials and utilities. Yet beneath that relief move, the underlying energy system is still strained. More than 800 vessels, including over 400 tankers, remain stuck in and around the Persian Gulf as insurers hesitate, and Iran retains tight control over transit conditions and potential tolls. Physical oil prices recently spiked to extreme levels, with some grades trading above $140 or even $160 per barrel, and refined products like diesel and jet fuel surpassing $200. Asia is already seeing demand destruction of around 1 million barrels per day, and the International Monetary Fund is preparing to cut its global growth forecast to reflect this negative supply shock. Infrastructure damage to Gulf refineries and liquefied natural gas facilities is expected to take years to repair, keeping the risk of structurally higher energy costs alive, even if spot prices have just fallen. There is also a timing issue that matters for macro. Analysts estimate a lag of roughly 2.5 months between the spike in Asian energy prices and its full impact on Western inflation data. That means the West is only now starting to feel the earlier surge in crude and products in its consumer price indices, even as the latest prints will be flattered by the recent pullback. Central banks are therefore juggling conflicting signals. Some see current pricing as consistent with a soft landing scenario where energy has a limited pass-through to core inflation but weighs on growth. Others warn that persistent supply uncertainty around the Strait of Hormuz could sustain elevated insurance costs and price levels, feeding a mild stagflation risk that would constrain policy flexibility. Beyond energy, the commodity complex is being reshaped by two powerful trends: AI-driven industrial demand and renewed demand for safety. Investors are rotating capital upstream in the technology supply chain toward miners and commodity producers that supply copper, aluminum, and other inputs for data centers and electrification. Mining equities had derated sharply even as some metal prices stabilized, but there are early signs of price floors and supply disruptions that support the underlying assets. At the same time, gold is reasserting its role as geopolitical and inflation insurance. Central banks in countries such as China, India, and Turkey have been adding to gold reserves, and precious metal miners are outperforming as the gold price rebounds despite improved risk sentiment. Rising government debt and higher bond yields have not derailed that trend, because many investors see those yields as compensation for inflation rather than evidence of stronger fiscal health. For portfolios, that makes commodities both a source of volatility and a key indicator of whether today's relief rally can transition into a more durable macro regime. Pulling it all together, the cross-asset picture has swung from a pure energy shock to a fragile relief phase. Equities have rallied hard, led by technology, small caps, and travel, as headline oil and gas prices tumble. Rates are edging toward a softer inflation narrative, but central banks remain cautious, and the path for cuts is still heavily dependent on the next few inflation and growth releases. Credit spreads stay tight even as private credit vehicles face redemption and liquidity pressures, and the weaker dollar is giving emerging markets some breathing room. Commodities remain the fulcrum. A historic drop in crude sits alongside unresolved shipping bottlenecks, infrastructure damage, and strong demand for gold and strategic metals. For allocators, the main watchpoints now are the durability of the ceasefire and Strait of Hormuz logistics, upcoming inflation data, and any further signs of stress in private credit and funding markets. How those evolve will determine whether this week's risk-on move marks the start of a new leg higher or just another sharp swing in an already volatile regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.